Hi, my name is Steve Parr, and I'm a Vancouver business lawyer, and today we're going to talk about family trusts and two of the most significant tax planning strategies that can be used in conjunction with a family trust. Family trusts are a complex subject, and beyond watching this video, you should discuss this topic extensively with your accountant and your lawyer to see whether they're a good fit for you. So the first tax planning strategy is the multiplication of the lifetime capital gains exemption. Now, the lifetime capital gains exemption applies on the sale of certain types of shares in privately held corporations. It can also apply to farm property, and there is also some application with the principal residence exemption. But for this example, we're going to just take a look at the sale of shares in a privately held corporation. So if your family trust is structured so that it owns the shares of a privately held corporation controlled by you, then upon the sale of that corporation, you and your beneficiary, the other beneficiaries that are named in the family trust agreement, can all make use of your lifetime capital gains exemption. So each person's lifetime capital gains exemption at 2020 rates is around $880,000. So if you and your spouse and two children, so if you're in a family of four, all made use of this exemption, then you could have a lifetime capital gains exemption of up to $3.5 million to shelter the gains of the sale of those shares. Please note that in order for this tax planning strategy to work, the shares in your company would need to be considered qualified small business corporation shares. And in order for them to meet that qualification, 90% of the assets that are held by the company need to be actively used within the business. And so if there's a stockpile of cash or other residual passive assets that exist within the corporation, then those will need to be pulled out of the corporation into another entity, whether it's a holding corporation or some other type of vehicle. And that's an essential piece in order to make use of the lifetime capital gains exemption. And you are going to want to discuss that with your accountant to ensure that you are properly implementing this strategy. The process for taking assets out of your operating company that are not actively used in the business is called purification, and a family trust structure can be beneficial in this regard, particularly when it's paired up with a holding company that can be effectively used to accomplish this process. Again, something that you should talk about in greater detail with your accountant. In terms of Canadian tax planning, taking advantage of the lifetime capital gains exemption is the most important tax planning strategy that an entrepreneur can make use of in their lifetime. And so this is something that you're going to want to discuss with your accountant and see whether it is applicable to your situation. The second type of planning that you can use within a family trust structure is called the prescribed rate loan strategy. So in 2018, the Canadian federal government eliminated much of the income splitting tax strategies that were available through family trusts through the tax on split income, or the TOSI rules. However, the prescribed rate loan strategy provides a variation on this type of income splitting strategy, and it's still available, and now is a good time to take advantage of this type of strategy. So how it works is that investment income that is held within the family trust can be split with a low-income spouse or other low-income beneficiaries under the trust, such as minor children. The high-income earner will loan funds to the family trust, and then the family trust will in turn use those funds to invest in publicly held securities. The yields from those public securities can then be reinvested by the trust and continue to grow inside of the trust. The benefit here is that because the low-income earners have a much lower marginal tax rate than the high-income earner, this tax planning strategy allows you to take advantage of that. Since the beneficiaries of the trust don't need to be paid out immediately each year, the earnings that are created through the investments that are held by the trust can be reinvested, and ultimately this can create significant tax savings over the long haul. As of the publication of this video, the prescribed interest rate is at a historic low of 1%, which means that this tax planning strategy can be highly beneficial, assuming an annual rate of return of 5 to 6% on your investments. Additionally, the prescribed interest rate is locked in at the time that the loan is created, which means that even if the CRA raises the prescribed interest rate at a later point in time, you are still going to be able to take advantage of whatever the interest rate was when you first created the loan. Now, there are some important caveats for this strategy that you should discuss with your accountant. The most important of which is that interest on the loan must be paid to the high income earner on January 30th of every year. And if it is not paid on that date, the tax attribution rules will take effect, and there will be no tax planning benefits to be yielded from this type of strategy. Thank you for watching this video. Please don't forget to subscribe, and if you have any other questions about this type of tax planning strategy and whether it's useful for you, please don't hesitate to reach out. Thank you.